Good morning and welcome to the TR Property Investment Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, we'll review all questions submitted today and publish responses where appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Marcus Fairmudge, Fund Manager, and Christine Cantrell, Head of Investment Trust Sales. Good morning.
Good morning and thanks very much. We're delighted to be here, and this is the first time that Marcus Fairmudge has been presenting in this format, so we're keen to get as many questions and also your feedback towards the end to ensure that we can deliver on what suits this audience best. But overall, I just wanted to give a quick kind of background on the company, or BMO Global Asset Management, where I work, has recently been acquired by Columbia Threadneedle, now making it one of the top 10 UK asset managers. So TR Property is still its own entity and will continue to be so. So a very quick update from me, but we look forward to having your questions later, which I'll moderate, but I'll hand over to Marcus now.
Thanks, Christine. Thank you, Paul. And good morning, everybody. I'm going to turn my camera off. Paul's going to pull up the presentation. Christine's going to kindly drive the slides. So as I said, this presentation is about TR Property Investment Trust, but really it's about, bigger than that, about real assets in a world of real inflation. And I think that's really what it's so front and center to where we are at the moment. And I'm hoping to give you some color as to how we've worked our way through that through that situation. Okay, next slide, please. And then these are just standard opening slides about BMO and then the Columbia Threadneedle, and we can go straight into so we're going to really cover off a very quick look at what the sort of organization around the investment trust itself, what else we run, how much we run, how we do it, and then we'll look at what the trust does, the track record, and then really about why to invest in property equities and why now, and then dig in a little bit into the portfolio itself, and then both the equity portfolio and our physical portfolio, and then conclude with the outlook. Our year end is the end of March, so we did publish our preliminary results last week, and there will be the full results will be on the website. They'll be signed off end of this week, beginning of next. So you will have a full market commentary by both the chairman and myself, for you to refer to alongside this presentation. So within the BMO real estate equity team, which I run, we actually have 6 separate strategies, of which the investment trust is the mothership. So we actually run about 3 billion. Most of that is in Europe, a couple of $100 million in global mandates. And then we also have physical property in the UK, not just in TR Property, but also in Property Growth and Income, which is our hybrid structure. So that's a mixture of more physical than TR Props. That runs at about a 65-35 equity physical, and as that's an open-ended fund. Which is proving quite popular for those who no longer want to own PAIFs. But anyway, moving on, let's get straight into the trust. The team, we've all worked together. A lot of us have worked together for a very long time. We're in the middle of hiring another analyst at the moment. We have another property asset manager starting also as well, and that'll bring us back up to 11-man strength. But importantly, we have been doing this together for a long time. Okay, next slide, please. And then a quick look, as I said, our year end was March, as the end of March, and some data about the trust itself. We are, as all investment trusts are, we are closed-ended. We can own physical property, although only up to 15%. The vast majority of our portfolio are pan-European listed property companies, both REITs and ordinary corporates. But really importantly, we do have the potential to gear. And we do currently have some gearing, which may surprise you, because investors may say, well, hold on, aren't you sort of nervous about what's going on? But bear in mind that because we have 7% of our assets in physical property, we're only actually geared against the equity market, around about 5%. And within our portfolio, we have specialized for many years in a large number of small and mid-cap names where we see growth and value and particular opportunities in particular subsectors. And those stocks are often quite low beta, have a lot of family ownership or founder ownership. And therefore, in fact, the portfolio doesn't feel highly geared relative to its benchmark. And then when we look at performance over the last 12 months, we're delighted to report NAV growth of 21.4%, handsomely beating the benchmark, which was 12.2, and then the share price return nearly 20%. And then, of course, since the end of March, and things have clearly materially derated across all sectors for obvious reasons. And we have suffered alongside that, but again, performing slightly better so far this year than the benchmark. But of course, it's only a couple of months in, but we may have more questions about that. Where it says current discount at the top 10.3, that's actually a bit out of date. The live discount today is about 8, so it has tightened up a little bit. Okay, next slide, please. And then the long-term track record, is something I was very proud of. I started my career at Knight Frank and Rutley, as it was there. I'm a surveyor by training. I moved in 1997 to Thames River to Henderson Investors, which had the mandate to manage TR Property Investment Trust. So I started working on the trust in 1997. My predecessor and I moved to Thames River Capital in 2004. Taking the trust, or the trust followed us, and then we built this group of other funds around that since then. And I took over from Chris Turner, my predecessor, taking control of the trust in 2011. So just had our 11th anniversary, of which we've managed to beat our benchmark every year. So we're very, very proud of that. So anyway, enough smoke blowing, and on to the next slide, which I think is the standard data we have to provide under FCA rules, so you can look at all the different numbers more recently. And then most importantly, moving into the core of the presentation, we look at our dividend history. Pleased to report another increase in the dividend from last year, 14.5p versus 14.2. But clearly, we're still in post-COVID revenue recovery. Obviously increased the revenue for the earnings from 12.2 to 13.7 over that period, which meant that we did draw a little bit. The board did choose to draw a little bit from reserves, but we still have reserves that equal about 12 pence per share. So we've still got a lot of revenue reserves if needed. But the midterm outlook for revenue recovery is strong, and I felt very comfortable that the board chose to dip into those reserves for a little bit. Okay, next slide, please. And then sort of pulling back, big picture, how do we see, what's the attributes of real estate, particularly commercial real estate, but also we have some exposure to residential, particularly in Germany, and I'll come on to that a bit later. But essentially, it's an income stream with a capital kicker. The vast majority of the annual returns that you get from real estate are from the income account rather than the capital account. But there are moments in the cycle where you do get these very significant capital kickers, and primarily where you get that capital kicker is through rental growth. So first of all, we're getting a margin over fixed income, and then of course your income isn't fixed. You can grow your income quite substantially. And the trick for me, that what's the core to my role, is finding those submarkets where tenant demand is stable or improving, but very importantly, where there is a lack of supply of new space. And it's really interesting when I look back at having been doing this job for a long time, and to my early career in the early 90s, where we'd had a huge development boom in the late 80s, which led to a lot of overconstruction. Rents took 3, 4, 5 years to recover. It was desperate, and it was all to do with oversupply and overdevelopment. And really post the GFC, so post sort of 2008-9, we saw banks very much pulling back from lending speculatively. We saw very little new development coming through, and where we did see it, if you look at the central London landscape, you look at the walkie-talkie, the cheese grater, the Shard, these tower blocks were not funded with bank finance. They were, they was backed by sovereign wealth money, big listed companies like Land Securities and British Land funding them. And then, of course, through COVID, again, there was another deferral to the development cycle as a lot of contractors were not able to get on site. And then when we look at valuation, we see that our sector is trading at a pretty serious discount to its collective asset value. We estimate that to be around a 16% discount to year-end NAVs when we look across the pan-European real estate equity landscape. So that's an opportunity that has very much appeared from the market sell-off in the last couple of months. Okay, next slide, please. Then when we look at last year and what drove some of our huge performance inside the trust for beating the benchmark so significantly, and it really was we were fortunate to be involved in quite a lot of M&A activity. I mean, I won't go through all of these, but very happy to take questions if anyone's looking at a particular stock. One I'd like to highlight is VIB Vermogen. This was a Bavarian industrial and logistics developer, very much providing building real estate for particularly the automotive industry, but also for a range of other growing German companies in a part of the world which was had a very difficult land supply, a bit like the southeast of England. The southern western part of Germany is the same situation. And a really good business. We've been involved in this business for over 10 years, buying shares initially at €10 per share, and it was acquired or partially acquired in a tender by DIC. Now we owned the tender offer by DIC was at €51.5 per share, but because we owned nearly 4% of the company, they came to us directly and said that we're prepared to pay more for your block of shares, and we actually extracted €54 per share, and we sold them our entire position, which was worth about €75 million. So it was a really big move for us and a very valuable one. We were in Amerstan, that was acquired by SBB, very big holders of Hibernia, which is the Dublin office developer, great business. So when we look at on the right hand side, businesses that have been taken private, so this is quite simply a situation where the stock market chose to leave these companies trading at significant discounts to their underlying asset value, and private equity, as you can see here in the form of Brookfield and Blackstone, have just come in and snapped up these businesses. They paid big premiums to the undisturbed share price. I think Hibernia was about 22% ahead of its price from the night before, but that still meant that Brookfield only really paid kind of NAV plus a tiny bit. So in a way, everybody was a winner, but ultimately we in the longer term have become losers because we don't have that fantastic business now in the listed space. But really, it's a reminder that more real estate is owned privately than publicly, and if the stock market is going to undervalue these businesses, then private equity and private capital will come along and buy it. So it's a really strong underpin and fills us with a lot of confidence because right now, we're in a highly inflationary environment, and real assets are very much something which investors want to get hold of, and we're seeing really good stability in pricing, in investment market pricing, for a whole range of assets. Not all subsectors, I hasten to add. Retail's still got its problems, and we'll probably touch on that. But many other markets where we're seeing robust demand from third party capital and from private capital. Next slide, please. And then into the equity portfolio. So just the sort of big picture stuff, where are we exposed? And as you can see here, we're about a third UK. We've got our little bit of direct property, and then primarily continental Europe. And then you can see the geographical split there. But actually, that's not the geography in itself in isolation is not that important to us. What's important is our subsector exposure. And if we go to the next one, please, Christine, you'll see. So this is the way we look at the world, and you might be quite surprised to see that some of those we're grouping stocks into these what we call them buckets, because not all companies fit neatly into each one, because some companies are diversified across different sectors. But essentially, what we're doing here is we're splitting companies into particular areas where we think they're going to be subject to similar macro drivers, which is why for retail, we split retail into UK retail, London retail, and continental European shopping centres. And that's really for a bunch of reasons. And the main one in the UK is that, of course, London retail is driven really by tourism. That's both domestic tourism and international, and we've very much seen a change in outcome for retail on the back of recovery in tourism in London, etc. UK retail, excluding London, is obviously much more domestic focused. But really, separating UK retail from European is very important, because UK retail has suffered for many years from having shopping centres that are invariably anchored by department stores that are, of course, sadly a failed and dying format. We've lost, BHS, Debenhams, even the mighty John Lewis have been shutting stores. Whereas in Europe, you remember from your French holidays in France, it's your local shopping centre is anchored by the hypermarket, by the Casino, the Carrefour, and that has continued to attract footfall. Whereas our supermarkets in the UK tend to be standalone, separate entities. Secondly, rents in Europe have been much closer to market rents and to share of turnover, whereas in the UK we've had this traditional 5-yearly upward-only rent review structure, which meant that rents became sort of detached from the reality of what tenants could afford to pay, and that, of course, has corrected very aggressively, sort of post the massive increase in sales online. In fact, if you go back to the 2014 TR property report and accounts, I was writing about the impact of first got a smartphone and realized that actually don't need to go to a shopping center anymore at all. I can buy all this stuff via the laptop or even the phone. So that's we've been very much cautious about retail. Although we have started to come back into European retail, and what these bars show you is a mixture of what are the constituents of our benchmark, which is in the dark blue. So you can see that there's a big chunk of German residential, big chunk of industrial, big chunk of European shopping centres. But whether we are overweight or underweight that particular group. Now, we can be underweight a particular group, but then still have a significant position in say one name, but none in the other. So UK majors, which are right down near the bottom, we own Land Securities, but Landsec as it is now, we don't own British Land. So that's always looking at a valuation play. But anyway, next slide, please. And then just to touch on some names. I mean, some of these may be familiar to you. You'll see that we are underweight SEGRO, which may surprise you, but that was merely on a valuation call. The shares got to £14, which was an implied yield of sub 3%. But more recently, the share price has corrected on the back of the sort of news from that Amazon are slowing their expansion plans, particularly in the US, which of course is not a market that SEGRO is in. Share price has corrected from £14 to £10.80, and we see that potentially as a buying opportunity. Argan, which is our biggest holding, this is logistics developer in France, 50% owned by the Lalonde family. We really like these small companies where there's an owner manager. They're as interested in the share price as I am. They're going to do the right thing. They're not going to overlever or overexpose themselves. They're not going to do crazy stuff because they are long-term holders. Industrials REIT, this is multi-let industrials in the UK with the old Stenprop Phoenix Spree is residential in Berlin. Safe Store, you'd be familiar with self-storage. But anyway, I can talk about any names that anyone wants to when we get to the Q&A. Okay, next slide, please. So ESG, obviously absolutely crucial to the way we are looking at our companies, and essentially, but it is, unfortunately, real estate is scores very highly on social provision. We all need, we want companies to create buildings for us to live, work, and play in. Governance, we have been all over for many years, and particularly through the corporate governance team at BMO. So we're able to lean heavily on our parent group to bring in that resource, which leaves us obviously with the environmental. And that's, of course, a big issue for real estate because it's a heavy user of energy and creator of embedded carbon. But the key for us is that not all companies are created equally. And just because Vonovia, which owns a lot of flats in Germany, all these flats were built, the vast majority were built in the 50s, the 60s, and the 70s. Clearly they have a lot of energy inefficiency. They need to be improved, but doesn't mean we're not going to own this company. It just means we need to be absolutely confident that the company appreciate what they need to do, and they've set out clear milestones of improvement. So we are prepared to support management who are exhibiting positive momentum. So that's absolutely crucial. And then a quick look at how the portfolio, and I think this is just a couple of slides to remind you all that, as you would expect us to do, to work very hard at rotating the portfolio to capture how market sentiment and pricing is evolving. You can see that through the pandemic, we quickly bought into what we saw as businesses that were going to benefit. So that was obviously logistics, that was healthcare, that housing was going to be very strong. Cebus, as an example, is a Scandinavian sort of equivalent of supermarket income REIT, is one that will be familiar with you. Vonovia, we talked about. Secure Income, you can see. PHP, you know about. And then coming out of an underweight stocks that we already didn't like, but we could sell even more of, the likes of Rodamco, Westfield. And then, of course, post the vaccine and the reflation trade, we rotated back and getting back into some of these names that we thought have been very undervalued or have been artificially smashed, the likes of Landsec and Jacina, etc. And then moving on to the next slide, where have we positioned ourselves in the first quarter of 2022? And obviously, starting with the terrible invasion of Ukraine, and then moving through the inflation data, we de-geared the business. From the end of January, we were 18%. By the end of March, we were at 9%. Then we've reduced exposure to businesses that we felt had moved up with events. We'd seen some recovery in the likes of Unibail. VGP is a logistics developer, but it does have quite a lot of exposure to Eastern Europe. So we felt that they were, that was something that was going to be a slowdown in their business plan. And then favouring value over growth. So Eddiston is retail warehousing in the UK. It's quite a small company, has a market cap of kind of 200 odd million, but it only owns retail warehousing. We've been trying to buy some physical retail warehouses. About a year ago, we thought this market was looking really cheap and attractive, and we were getting outbid quite aggressively. And we thought, wow, the investors are really coming back into this world, and we got an opportunity to buy quite a big chunk of Eddiston. In fact, we own close to 10% of it, and we bought that at 65p, and the share price is now over 80. So we're really pleased with that. And then you can see, Klépierre, and which was European shopping centres we've talked about, and then buying back into the likes of Landsec, which have been very bombed out, and then holding on to defensive names, so Switzerland, PHP, and then supermarkets. So almost going back into those deep those index linked income names lots of defensive characteristics. We're confident that Sainsbury's and Tesco are going to pay their rent. We're confident the NHS is going to pay its rent. And in Switzerland, we're very confident there where the large range of corporates that are doing remarkably well in these times. Okay, next slide, please. And then a little bit on the physical. I'm often asked, why do we buy the physical? And I think I've given one reason, which is an opportunity to be closer to the physical market and to be able to anticipate changing trends, particularly on pricing from and direct market investor expectation and desires. And then the second reason is that we like to be able to create value. And we've done, a really good job in Bayswater, and we've got planning in Wandsworth, and Bayswater is actually on the market now, and we hope to sell that asset. But and then the other area that we like to own is markets where if they're trading at large premiums in the equity market, so you've got stocks trading at big, like Seagro was very large premiums to its asset value, we've got an opportunity to go and buy physical property at asset value. That's a good arbitrage from our point of view. So next slide, please. So just a little bit of a story on Waitrose at Bayswater. So this is junction of Bayswater and Queensway. We're familiar to you as a big block. We bought it a long time ago, and we've been very busy turning it into what it is today. We persuaded Waitrose to move to first floor because we said we can give you a full 40,000 square feet, which they were very attracted to in this dense, rich urban submarket. And that freed up the ground floor, which we then let to Graham and Green, to Specsavers. One Rebel is a very smart gym operator, and then Happy Lamb Hot Pot, which is a Mongolian restaurant chain, very successful in the US, got a couple here and growing busily. And now we've completed the exercise on that. So this property is on the market at the moment. Okay, next slide, please. And then at Ferrier Street, Wandsworth, some of you will be familiar with the Tonsleys. It's a nice Victorian part of Wandsworth, quite close to Wandsworth Town Railway Station, and a pub that's quite popular called the Alma. For those of you who know Southwest London, I bought this industrial estate in 1998. The rents were £8 a foot. We still have these buildings as they are in the picture on the left-hand side. Last deal we did was at £30. But in the background, we spent the last 18 months, 2 years getting planning permission to actually build a mixture of multi-story industrial, residential, and some offices. So we've kind of proved the envelope, as it were, and we still have that planning permission. It's new. It lasts for 3 years. We won't do this development ourselves. We might joint venture it. We might sell it. But in the meantime, we're still getting huge demand for urban logistics and industrial. We have a lot of food users in this estate because it's so close to central London and so useful. And of course, we've lost a huge amount of industrial property in the Greater London area over the last 30 years because there's always been a higher value use of the space, because you can go, the moment you can go residential or hotel or office where you can build multi-story, of course the land value then becomes so much more valuable for those uses. So people have lost a lot of, we've seen the destruction of a lot of industrial space. That's made it all the more valuable. So we're really, really pleased to own that now. And then I think just to bring things to a conclusion, really it's about what does real estate offer us? It offers us the income that we still need. Interest rates are rising, but they're still just not getting enough income, and certainly not inflation protected income. So the vast majority of our income in Europe is index linked, and a huge amount, increasing amount of it in the UK. If you think about our exposure to healthcare, to supermarkets, things like LXI, Secure Income REIT, long income streams from high quality covenants, index linked, really, really important. And then finally, what we, capturing these accelerating real estate trends. We know what's going on in retail. We think that retail parks, which is the Eddiston, which is those big boxes, when you go to buy B&M or Pets at Home, etc. These are easy to access. You park outside, really good for click and collect, really good for easy returns. Flexible offices, we see that very much becoming a feature. Companies not wanting to commit to long leases, but wanting to have plug and play accommodation. Ever increasing focus on building quality and ESG, and we see a lot of that in the listed space. A lot of high quality buildings. You look at something like Helical Bar. Its portfolio is all BREEAM rated. And then residential demand, we feel very, very confident about residential, particularly regulated markets such as Germany and Sweden, where rents are Frau Miggins is paying a sub-market rent. She's not going to move out of her flat. It's very, very stable. We have 99% occupancy levels in these companies that we're invested in. So really, really strong and stable income stream. So as we said at the bottom, index linked income in a real estate wrapper. So there we are. I'm just inside my self-imposed half an hour of talking at you. Really hope that we can get some questions. So I'm just going to turn my camera back on. Christine's going to control the Q&A.
Where we go.
So there we are.
Wonderful. Look, Marcus, thank you very much indeed for the presentation. And ladies and gentlemen, as Marcus said, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. Just while the team take a few moments to review those questions submitted already, I'd like to remind you that recording this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Christine, Marcus, as you can see, you've had a number of questions that have come throughout today's presentation, so thank you for all the investors for submitting those. Christine, if I may just hand over to you just to read out the questions where appropriate to do so for Marcus, that'd be great.
Super, thank you so much. So we'll kick off. There's been a number of questions specifically on sectors and then individual names, but I'll start off with a kind of more high-level question from Jens. What is the beta of the trust to the general market and separately to fixed income?
That's a great question, and I don't have the answer at my fingertips, I'm afraid. I think for us, what's more important is the beta of our portfolio versus broader real estate equities. And as I said at the beginning, we really benefit in this trust by being a permanent capital vehicle and having an ability to invest long term, particularly in these small and mid cap names that by their very definition, they are less liquid, and you do therefore get they find greater stability in those share prices. So I'm sorry I don't have the numbers. We will take that question away and work on it and come back to you. If you could make sure that Christine has your email address, we'll get back to you on that.
Actually, the whole website will be able to help us with that, so we can publish the question and answers afterwards. So then going to more of a sector question, how do you assess the risk in healthcare names, specifically primary versus non-primary?
Yeah, this is a good question. And I think the focus is essentially our healthcare groups fall into three categories. There's the primary and acute, which is invariably directly or indirectly backed by state medical. So in the case of the UK, it's obviously the NHS and the equivalents across Europe. At the other end of the scale is elderly care, both this is nursing home and sheltered housing, but nursing home and sort of end of life care. And there the operators are, it all depends on your different jurisdictions as to how much of that is ultimately funded by the state and how much of it is private. Of course, a lot of this is very much in the headlights and in the headlines around Orpea, which is the very large French company where there has been an expose of all sorts of felonies by that business, both financial and at the operational level. So we do very importantly, the companies we're exposed to have very limited exposure to Orpea itself, but we do monitor carefully the rental affordability of these tenants, and we're aware that at the end of the day, for any operator of a nursing home, the vast majority of cost is staffing. And that, of course, is going up, and we need to be sure, particularly on the continent, that those rents are that the affordability is there. That's something that we clearly look at very closely. You have to accept that where you have, such as Belgium, where you're getting full recovery from the state, then it's really the state's responsibility to ensure that there is the right amount of provision. And in fact, in Finland recently, there's now been a change in the law as to the number of the staffing levels per client has changed. That, of course, has made it much more expensive to operate, and that has then been funded by additional finance from the state. So that's obviously what we're looking at. In the UK, our exposure to the nursing homes is only through Target Healthcare, which is very much a very high-end provider. You can measure the quality of a care home essentially by the number of rooms that have their own wet room, their own bathroom. You'd think that would be standard, but it's absolutely not. But it's a very good, and it's for Target, that's 100%. They have one tenant who they're in discussions with at the moment, but where this has happened in the past, they've been able to replace them. So again, checking affordability is absolutely crucial to our exposure in these names.
Great. Gosh, there's quite a few questions. If we want to drill down into maybe more names, why do you prefer Safestore to Big Yellow, for example?
Yeah, this is a good question. And the answer is you almost have to make a decision on one or the other. And in fact, the gap between the two in terms of our valuation metrics have narrowed hugely. I would say that we actually like the model where there's a greater higher level of rental rather than ownership. So you're effectively using your balance sheet, we think, more effectively. What we found is that Safestore have been able to extend and renew their leases on buildings that they rent rather than own themselves very, very efficiently, and that's it means that they need less capital to be tied up in the assets. The second thing is we really like the Paris exposure. Paris is incredibly tight. It's almost impossible to build any new self-storage facilities at all. So what warms a property owner's feelings more than anything else is a market where supply is incredibly limited, and that's great. But we hugely admire both the Big Yellow and Safestore management teams. They're both excellent, and what we love about them is there's almost an eyeball oligopoly. In as much as if you were to type in self-storage in any particular location that you're based, it would almost be impossible to avoid at least getting a quote from one of those two big names, or maybe possibly Shurgard or Access as well. But and because really 90+% of all inquiries come through the internet, it's a great business model that you make. The customer may not take your price, but at least you've got all retailers would kill to be guaranteed that to have a chance to sell their product to pretty well the whole market. So that's we really like that particular subsector.
Nice. And moving to the office sector, do you see an opportunity for suburban office hubs for work from home workers that don't have good facilities at home, where a community could be created? And Mark is also asking, is there currently any company with a focus on this?
Yeah, great question. The answer is the post-COVID working from home evolution is very much evolving, almost as we speak. I think that the more companies we talk to, we realise that essentially it's becoming quite a UK and to an extent French issue. And essentially, and what I mean by that is for most other European cities, commute times are relatively short. They're relatively comfortable, either private transport or if it's public, it's invariably good quality and air conditioned. If I think about Stockholm or Gothenburg or Munich or Berlin, It's above ground. And we've seen very high levels of return to office. And that's essentially because we all know the benefits of being in the office, the benefits of sharing information with our colleagues, the change of environment, not sitting in your pajamas, etc. And actually, but the reason that we're so put off, particularly for those in London and Paris, is the length of the commute. So what we've done in our business is we do a three here in the office. We're in the West End and working remotely 2 days. Now, of course, you're dead right. Not everybody has. I have colleagues who live in London and they come to the office 5 days a week because they don't want to sit in their flat in Docklands when their other half is on the other sofa. So trying to do the same thing. So yes, I think there will be evolution. Will it be of scale? I think the likes of Regus and other flexible and service office providers will be providing those regional hubs, and we're seeing it in a range of hotels, regional hotels that are trying to find use for their space during the daytime. So yes, it's already there. You certainly will, particularly not in super rural areas, but certainly in suburban areas, you will find these sort of facilities growing. Is there any listed company that's particularly exposed to that? I would say that Workspace is very much trying to look at that. It recently bought Mackay Securities. We had a big holding. We own 10% of Mackay. We're really pleased with the deal. It was highly accretive for us. Mackay has a portfolio of suburban offices in the southeast, outside of Workspace's core Greater London exposure, and they very much feel that there's a chance to move to that flexible model in places, Wimbledon and Croydon, and Reading, and even further afield. So yes, absolutely, coming to a town near you.
Fabulous. Jens now is asking, how do you assess the risk of long index holdings? Why do you not hold, or why would one not hold 100% in long index property, and what's your thinking around that?
Yeah, great. Again, great question. The answer simply is that it's all well and good having index linked. Now in Europe, that index linkage is to the main part uncapped. Now, if we do get 9% inflation, and let's hypothetically, God forbid, it's for several years, you'd have a situation where your rents would rise way ahead of market. Average lease lengths in Europe are sub 5 years. With many with breaks at 3, so you very quickly correct back to the open market rent. So that's the situation in Europe. In the UK, you do have these many, and we've got lots of examples, as I said, of much longer index linked income, but invariably capped, and that cap is at around 4%. So generally capped and collared 1 and 4. If you go onto Supermarket Income REIT's website, you'll see that the vast majority of its income is capped at 4. So you have a situation where you may not be able to capture 100% of that inflation in that period. Now, at the same time, the other reason that you wouldn't put all your eggs in that particular basket is because the stock market has already begun to reflect the attraction of that sector, i.e. those names are trading at asset value or premiums to asset value, where there are many other sub-markets and stocks that are trading at large discounts to expected asset value. So essentially for me, the job is to make sure I get ahead of the curve, and to have been buying this index-linked income last year, not because I predicted the invasion of Ukraine, but what we did start to see was a change in sentiment towards the price of money, and expectation that there was going to be inflationary pressures, and that central banks were going to, QE was over and we were moving to quantitative tightening. We were going to see the central banks reduce the size of their balance sheets. This was going to create some additional inflationary pressures, and therefore we've been buying this stuff early on. So we have already made that, we've got names that are standing at big premiums in that index-linked space that they're still fair value. And I was talking earlier to an investor about it's like buying a life jacket. But my job is to make sure that if there's something else that's very cheap, might have a little hole in the boat, but I may be able to make a lot more money in the short run, rotating from my highly priced but valuable index-linked life jacket, moving into something else. I hope that sort of vaguely makes sense. But that's the reason. Those are the reasons why.
Yeah, I think it really helped. And also on a related note, Anthony's asking, on a look-through basis, can you provide a breakdown how much of the portfolio is index linked, and in terms of ESG or EPC, how much is above C? And it might be that we come back to him later.
Yeah, so dealing with the former, obviously all of our European exposure is index linked to a greater or lesser extent. You just have to be careful with how quickly you're going to capture it. Some of it, in particularly, so France, there's a different index for offices as opposed to retail industrial. Some of it is partially linked to building costs, which of course it's taking time for those building costs to come through, and they will be reflected for a long time, even after headline CPI starts to drop. So you have to look carefully at the timing and the quantum. In the UK, I don't know the number off the top of my head, but I would suggest that it's probably a third of our portfolio is has an element, is index linked, and that's because of the likes of supermarket. And I would argue that self-storage, whilst it's not formally index linked, essentially there's a very quick transmission, and we've seen that self-storage has been traditionally been able to move those rents up because, quite right, the consumer has got it embedded in his head. He or she is seeing what's happening to his or her cost of energy, price of petrol, etc. They're not surprised when that 3-4% increase or 5% increase in their self-storage bill comes through the door. Now they might choose to take it out, but what are they going to do with it? And that's this whole thing about this stickiness and stability in that particular space. On EPC, it varies hugely, and it's not relevant because they're all moving in a certain direction. At the end of the day, every company is having to qualify, every UK company, in relation to the legislation for 2028, which is when they need to be a C, 2030 when they need to be a B, and they're quantifying and qualifying what that is now. So the issue isn't what percentage is there now, it's what's the cost going to be to get there, and is that factored into the share price. It's very granular, and I think that again, it's a moving feast, but we are very conscious of it and have reduced exposure to quite a lot of our remove secondary office exposure all over the place on the back of that.
Interesting. And now moving back to the portfolio level, Jeremy's asking if you could comment on what level of turnover did you have last year, or what is it in most years?
So turnover is roughly a third. That's purchases and sales divided by 2. It does fluctuate. I'm sorry I haven't got the number in my head. It is in the annual report each year. So we do give the figure. However, it is obviously we if we get a situation like with the year we've just had, of course, when I sell 100% of my holding in VIB Vermogen, or 100% in Alstria, in Hibernia, in Amastan being taken over by SBB, this will inflate the numbers. So I'm getting that cash back, and I'm either de-gearing or I'm reinvesting it. So you can get periods where that number will be significantly larger. So we don't choose to X that M&A because that would be, which bit what about a partial buyback? It would be silly to try and sort of micromanage that number. But to give you some idea, it's roughly a third. But I have holdings that I've owned for 15 years more, and happily built on them and still own them. The case of VIB Vermogen, which we started buying over 10 years ago, I think we built a holding that we exited at 75 million euros. I sold stock on only 8 occasions in that decade. So it can vary hugely. I've been in and out of a company this week, in and out. So it can vary hugely.
Okay, that gives us a good idea. Now talking about Berlin, can you talk about the rent controls in Berlin and how this can be turned into market rents?
Yeah, it's a great question. So a little bit of history. Remember that Berlin, and apologies to those who are very familiar with the situation, but essentially there is regulated rents across the whole of Germany through something called the Mietspiegel. It's very complicated. It varies hugely, almost street by street, certainly town by town. Berlin is clearly a fantastic city, It's attracting a lot of investment, of immigration from both abroad and the rest of Germany. It's seen as a young, vibrant, great city, and rents have risen very dramatically. And that has the local authority, very left-leaning, attempted to bring in a control called the Mietendeckel, which is effectively a rent cap to stop rents rising, even though many of the tenants were paying sub-market rents. Rents were the Mietspiegel, so the regulated rents, were themselves growing quite quickly, not as fast as regulated rents. So one was kind of doing sort of 5, 6, 7%, while open market was doing 20, but it was still rising fast, and the locals, still wanted to get to live in this fantastic city very cheaply. So it was a populist move. Essentially the Court of Appeal, the Supreme Court of Germany, ruled that was not constitutional. That only the national level could you impose a rent control. You couldn't do it at the city and state level. So our view is that we think that at the end of the day, there is huge demand for residential in Berlin. That the Mietendeckel has been removed. We've gone back to the Mietspiegel. Our exposure is all through a company called Phoenix Spree. Now, what's exciting about Phoenix Spree is that they've been really, really clever. Over a long period of time, they've got the permission to take each block of flats. So let's pretend that there's one which has got 20 flats in it. At the moment, they're all let on regulated rents. When one of those rent units becomes vacant, rather than putting in another tenant after you've refurbished it, you can put it in at a higher rent. Actually, if you have permission, you can sell that rent like a share of freehold flat, a condominium as it's called, to an individual as an owner occupier. You could sell them a share of freehold in perpetuity, and those values are, of course, clearly 20 or 25% ahead of the value of the unit let on a regulated sub-market rent. Now, you can't do this all the time. It takes many years to do it, but it basically means that if you take the asset value of the NAV of Phoenix Spree, you know that number is going to climb every time they're able to get these units back and sell them. And they have the right to condominionize, which I'm not sure it's even actually a word, but anyway, you know what I mean, to convert 75% of their portfolio. Now, it's going to take a very long time to do that, but it's a real valuation underpin for us. At the same time, the share price is trading at a big discount to the asset, the ordinary asset value, not the potential one. And the company know this, and they've been selling apartments and buying back shares. And we absolutely applaud that. In fact, we want them to accelerate that, because essentially there's just, this is then money that can be absorbed in the NAV per share by all those holders who don't sell their shares. And if there are people out there who want to sell their shares at a lower price, it's absolutely great that the company want to buy them back. We want them to accelerate that. We're very positive about the Berlin market.
Yeah, great. And going back to Paris, Helen is asking about Gecina, if I'm pronouncing it right. Gecina.
Gecina, yes.
Okay, thank you.
Well, there you go, Christine. You've learned the pronunciation of Paris's largest office owner. So, I think Paris is very much a very similar situation to London, which is that in the core, which of course is a lot of the Gecina portfolio, rents are stable, if not rising. There is still very good demand for the right quality buildings in the right place, and who wouldn't want to be working in central Paris? Canary Wharf, Docklands, La Défense, a lot of similarity where we're seeing, there's certainly oversupply of space, consolidation amongst financial services businesses. There is oversupply in some of those Western peripheral markets. But we saw Covivio this morning announce a fantastic, a huge deal, essentially 300,000 square feet, new letting. So we're very confident about that market. But at the end of the day, there's still, it's a big city, and it's the similar situation to London, where we haven't had that full return to office yet. But what we expect is this green building super cycle, which Jacina will be able to capture through its development program. We welcome the new chief executive. We think that's a great hire. We were not fans of the previous chief executive at all. We felt that she didn't have a vision for the business, and we were, really felt that there was a political drive not to buy back shares. We think this business it could happily shrink as well and create value that way. We have high hopes and we maintain our holding. We think the stock is cheap.
Great. Gosh, we're running up to an hour, but I'll ask Matthew's kind of complicated question comparing the UK/EU REIT to those in America. So he's asking, the UK and EU REIT investor base is highly fixated to published NAV. Would you support changing the reporting model similar to the American model with the publication of FFO, which I believe is funds from operations / adjusted funds from operations, alongside same store NOI supplementary material to determine the NAV yourself based on your cap rate assumptions?
It's a great question, and the answer is we not only produce our own FFO and NOI figures for all our companies if they're not provided by the companies. We know that the NAV figure is a backward-looking third-party assessment of value. Everybody on this call who's ever bought and sold residential property on their own behalf will know that it's amazing how in a liquid market, 3 separate estate agents can come up with 3 very different figures for the value of your house, and that's no different. So when I hear that somebody on the seller side tells me that it was a 1% or 0.5% miss on consensus NAV, I just slightly chuckle because at the end of the day you can't tighten up that spread. But I do think that third-party independent valuation has a value, and it is useful as one of a number of metrics. But we do not, I don't buy and sell because something's standing on a premium so it gets sold and it's trading on a discount, therefore it's buy. Absolutely not. It's much more complex than that. The US doesn't do it because they don't actually have a history of third-party independent valuation either. So they've gone quite rightly in a way down that route. But then they obsess about minor misses on EPS quarter by quarter, which is also not particularly helpful when you've got to be able to prepare to weather bumps in your cash flow in the short term. You've got to be looking at so the answer is we need all of those metrics, and we need to continue to use all of them. I think that the credit agencies need to be smarter and more investigative about some of the rather, let's say, creative balance sheet structures that we're seeing in EPRA. The European Public Real Estate Association, so essentially our trade body, have done a really, really good job in trying to get to the bottom of real loan to values. So, how do you assess hybrids, perpetuals? You cannot just assume these things are debt when they're really partial equity, et cetera, et cetera. I'm getting complicated, but I hope I've given you a bit of an answer to help. But we can carry this discussion on offline if necessary. What the US is really good at is basically, because it doesn't obsess about NAV, is raising capital. This crazy situation in Europe and the UK where, you can't raise capital below NAV because that's dilutive. Well, that really is a load of beep, because essentially that you're just stopping these companies from growing. And we absolutely need to grow the listed space. With the death of the property PAIF, the open-ended daily dealing property fund, which is a fundamentally broken structure, investors need to get access to real estate. And one of the great about the REIT world is the fact that I, or you as an individual investor, you can pick and choose whichever subsector you want. I've got a huge playing field, whether I want to go into Spanish offices, Finnish regulated residential, only retail warehousing in the UK, etc., etc., etc. You know, it's great. Whereas I think many investors have been offered this very narrow world of IPD obsessed, UK only. Oh, we're half retail, quarter offices, a little bit of industrial. You know, that model is long gone, and that's why the listed space is so, is so attractive. We need to grow it.
Fabulous. Well, I think we're up to time, and your time is very precious and valuable to us. So thank you very much, Marcus. I think I hand over now to Paul.
Fantastic. Christine, Marcus, thank you for addressing so many of those questions. And of course, you'll have the ability to review any further questions. We can publish responses where appropriate to do so on the Investor Meet Company platform. Marcus, perhaps just before we do redirect investors to provide you with their feedback, which I know will be particularly important to you, can I just ask you for a few closing comments?
Well, thanks, Paul. And first of all, thank you, ladies and gentlemen, very much for your time. And in closing comments, I think I'd probably just like to reinforce the fact that, we see, I'm not some perpetual bull, even though I've been doing this job for a very long time. Remember, we were TR Property had 20% cash in the quarter before Lehman's back in Q2 2008. But right now, we feel really quite positive that we're investing in companies that have got, particularly those who've got long dated debt. They can weather the storm of the short-term rises in interest rates, that you've got high quality earnings, a lot of index-linked income, and that actually in what's going to be fairly tumultuous times over the next quarters and potentially years, that actually some solid, well-run, well-managed, well-financed, hard asset-based businesses will be attractive to a large range of investors. And I would just remind you that TR Property Investment Trust today is standing on a 7% discount. It's been trading at parity a lot of last year. So we have seen some correction in pricing. We're at a closed period. I personally will be buying shares. And as the manager, I'm not a director on the board. I'm not required to give you my holding, but I can tell you that after my house, it is my next largest investment. I'm very happy. I'm a very long-term holder. And I think I must stop talking because, as many of you know, I do like to bang on. But can I just say thank you very much for your time this morning.
That's fantastic. Marcus, thank you again for updating investors today. Please ask investors not to close the session. To be automatically redirected to provide your feedback in order Marcus and the team can better understand your views and expectations. This will only take a few moments to complete and they'll be greatly valued by the team. On behalf of TR Property Investment Trust PLC, we'd like to thank you for attending today's presentation. Thank you and good morning to you all.
Bye-bye.